You don't need to be rich to start investing. You need this simple system. I think nobody tells beginner investors because, after all, let's be realistic, there is a lie about investing that keeps millions of ordinary people on the sidelines. And the lie is this: you need to know a lot about the stock market before you can start. You need to understand charts. You need to know how to pick winning stocks. You need to understand complicated financial terminology. But yet, if we're being honest, all of these things are irrelevant to the fact of building wealth. And you might ask, you need thousands of dollars. You need to constantly watch the market. Once again, that's the biggest lie we've all been taught and heard repeated over and over again. You need to know exactly what the economy is going to do next. And if you don't know any of that, you feel like investing isn't for you. So you wait, you tell yourselves, I'll start when I make more money. I'll start when I get out of debt. I'll start when I understand the market. I'll start when I have enough saved. I'll start next year. And then next year becomes the year after that. And eventually you look up and realize you've spent 5, 10, maybe 15 years earning money, but never really learning how to make your money work alongside you. That is what I want to change in this video, because investing doesn't have to be complicated. And I'm not going to sit here and pretend you can become wealthy overnight by buying some random stock. You can't. There are no guaranteed returns. There is no magic ticker symbol. There is no secret investment that makes you rich while you sleep. Building wealth through investing is much more boring than social media makes it look, and that's actually good news, because boring is something ordinary people can do. You don't need to become a financial guru. You need to understand a few basic principles, build a repeatable system, and give that system enough time to work. So today I'm going to walk you through exactly how a complete beginner can start thinking about investing. What account to open, what you're actually buying, how much you should consider investing, what to do if you only have $25, what to do if you have $100, what to do if you're living paycheck to paycheck. These are all pretty typical questions people have when thinking about getting started trying to grow your income and build wealth towards leaving a legacy behind for your family. However, I can't stress enough to you all about not just investing into any just random stock or mutual fund after all. Investing is not the same thing as gambling, but look at it like this. What are some of your more popular brands that you use? Before we talk about what to buy, we need to clear something up. A lot of beginners look at the stock market and think, see, this basically gambling? And honestly, if you're randomly throwing money into stocks because somebody on TikTok said they're going up tomorrow, then the answer is yes, that can become extremely speculative. But long-term investing is a different concept. When you buy shares of a company, you're purchasing ownership in that business. When you invest through a diversified fund, you're buying exposure to many companies. You're not simply handing your money to a machine and hoping it spits out more money. You're putting capital into productive assets. Businesses generate revenue. Businesses earn profits. Businesses innovate. Businesses expand. Businesses create products and services. And over long periods of time, investors can participate in that economic growth. That doesn't mean every company succeeds. It doesn't mean every year is positive. It doesn't mean the market goes up every month. It certainly doesn't mean you'll never lose money. Markets fall, companies fail, recessions happen, economic crises happen, geopolitical events happen, interest rates change, investor sentiment changes, and sometimes the market gets absolutely crushed. But here's the important distinction. Short-term price movement and long-term wealth building are not the same thing. If you're investing for 20 or 30 years, your objective shouldn't be, how do I predict what the market does next Tuesday? Your question becomes, how do I consistently own productive assets and stay invested long enough to give compounding a chance? That's a completely different game. And that's the game beginners should learn. And after all, it doesn't take rocket science to study businesses and learn the ones who have truly long track records, or companies that just about everyone in the world uses or owns their products. After all, there are several books you can read that will teach you about investing and how it works. From well-known financial gurus to people who run radio talk shows like Dave Ramsey, or even the author of Rich Dad Poor Dad, even though they both have a completely different approaches, it still teaches you knowledge and gets you focused towards buying assets. And might I say, you don't have to become a financial expert, but you do in fact need to know how to handle your personal income, even though the world has financial advisors and so on, if we're being realistic. They are welcome to teach and show you certain things, but when it's all said and done, you should have the final say so. That's why I say you can never gain too much knowledge from one place. Now look, you don't need to pick individual stocks. That isn't the only option. However, let's address one of the biggest misconceptions. You do not have to become a stock picker. You don't have to spend every night researching individual companies. You don't have to find the next Amazon. You don't have to find the next Nvidia. You don't have to predict the next huge winner. In fact, one of the simplest approaches for a beginner is broad diversification. And this is where index funds come in. An index fund is designed to track an index rather than have someone constantly trying to pick individual winners. For example, instead of buying one company, you can invest in a fund that owns pieces of hundreds or even thousands of companies. Think about what that means. If you put $100 into one individual company and that company has serious problems, your investment can be heavily affected. But if you put $100 into a broadly diversified fund containing hundreds or thousands of companies, one company having a bad year doesn't destroy the entire portfolio. That is the power of diversification. You don't need to know which company will dominate the next 20 years. You can own a broad slice of the market. This is one of the reasons broad market index funds and ETFs are commonly used by long-term investors. They're simple, they're diversified, and they remove a huge amount of the pressure associated with picking individual stocks. Now, that doesn't mean every index fund is identical. They're not. You still need to understand what you're buying. You need to look at what index it tracks. You need to understand what assets it holds. You need to consider expenses. You need to understand the risk. And you need to make sure it fits your overall financial situation. But the larger lesson is this: you don't need to predict the future to participate in long-term economic growth. With that being said, let's dive into the 3 buckets you need to understand. Before you invest your first dollar, I want you to understand 3 different jobs your money can have. Because this is where beginners get themselves into trouble. They invest money they actually need. Don't do that. Think about your money in 3 broad buckets. Bucket number 1, money you need soon. This could be rent, utilities, groceries, insurance, transportation, bills, anything you expect to need in the near future. That money generally shouldn't be exposed to stock market volatility. Bucket number 2, emergency savings. This is your financial shock absorber. Your car breaks down, your hours get cut, you have an unexpected expense, something goes wrong. An emergency fund can keep you from immediately reaching for a credit card or selling investments at the worst possible time. Bucket number 3, long-term wealth building money. This is money you don't expect to need for many years. That's where investing becomes much more appropriate. This distinction is critical because if you invest your rent money and the market drops 25%, you may be forced to sell while you're down. That's not the situation you want. Investing works much better when you can give your investments time. So don't think, should I invest or save? Think, what job does each dollar need to perform? That's a much better question. Because after all, the money is yours, but in order to grow your income, you need to have some type of planning behind each move you're making. So I guess what exactly it is that I'm wanting you to fully understand is before even thinking about investing, make sure you have those 3 buckets controlled. This helps you to avoid interrupting your investment strategy that you have started. But hold up a second, what if I am broke? Now let's get extremely practical, because this is where most investing videos lose people. They tell you, just invest $1,000 a month. Okay, what if you don't have $1,000? What if you have $50? What if you have $20? What if you have $10? What if you're currently living paycheck to paycheck? Here's the truth. Your first investment doesn't need to impress anybody. If you can invest $25 consistently, that's more important than investing $500 once and disappearing for 6 months. Because we're building a behavior. Let's say you start with $25 per paycheck. Maybe that's all you can reasonably afford. That's okay. The goal isn't to make the amount look impressive. The goal is to establish the habit. Then maybe 6 months later you get a raise. Instead of spending the entire raise, you increase your investment contribution. Maybe your $25 becomes $40, then $50, then $75, then eventually $100. This is how ordinary people can build investing capacity, not by pretending they're rich, by gradually increasing their ability to invest. And here's something important. Don't destroy your financial stability trying to look like an investor. If investing $100 causes you to overdraft your checking account, the problem isn't that you're not investing enough. You're investing too aggressively relative to your current situation. Your investment contribution needs to fit your financial reality. So listen, let's discuss the first account you need to understand, and let's talk about where you actually put your investments. You generally don't just walk into the stock market and hand someone cash. You use an investment account. There are different types of accounts and they have different purposes. For retirement, you might encounter an employer-sponsored 401k. You may also hear about an IRA or Roth IRA. And then there are taxable brokerage accounts. The important thing is understanding that the account is the container. The investment is what you put inside the container. This distinction is extremely important. For example, a Roth IRA is a code type. An index fund can be an investment held inside that account. A brokerage account is another account type, and an ETF can be an investment held inside that account. Don't confuse the account with the investment. Now, if your employer offers a 401k match, that deserves serious attention because employer matching can effectively add money to your retirement savings according to the plan's rules. You should understand the specific terms of your employer's plan. For a Roth IRA, contributions are made with after-tax money, and qualified withdrawals can generally be tax-free under the applicable rules. But tax rules can be complicated and depend on your circumstances, so don't blindly copy something you saw online. Understand the rules for the account you're using. The bigger lesson is, choose the account based on the job you're trying to accomplish. Then choose investments appropriate for that account. Alright, so let's assume you got everything in line and ready to invest with $100. You have your basic expenses covered, you've started building some emergency savings, you're not using money you need tomorrow, and you have $100 available for long-term investing. What do you do first? You don't need to panic. You don't need to find a stock that can turn $100 into $10,000. You don't need to spend 3 weeks watching YouTube videos about candlestick patterns. You need a plan. You open an appropriate investment account with a reputable brokerage. You fund it. Then you research diversified investments that fit your goals and risk tolerance. For a beginner focused on long-term wealth building, a broad market index fund or diversified ETF can be much simpler than trying to build a portfolio of dozens of individual companies. And then you make your investment. That's it. You didn't become Warren Buffett. You didn't need to, you became an investor. That first $100 might not change your life financially, but it can change your behavior. And behavior is where this gets powerful. After all, let's go into the importance of why compounding matters so much, one of the most powerful ideas in investing. Compounding. Compounding means your returns can generate additional returns over time. Imagine you invest money. That money earns a return. You leave the money invested. Now future returns can occur on both your original money and the previous gains. That's why time is so important. Let's use a hypothetical example. Suppose someone invests $200 per month for 30 years. That's $72,000 of their own contributions. If the investments generated an average annual return of 7% over that period, compounded monthly, the hypothetical ending value would be roughly $244,000. That does not mean 7% is guaranteed. It isn't. Real-world returns vary dramatically. But the example illustrates something important. The investor didn't personally contribute $244,000. They contributed $72,000. Time and investment growth potentially did a significant amount of the heavy lifting. Now imagine increasing that contribution over time. Maybe you start at $200, then you get a raise. You increase it to $250, then $300, then $400. Your income grows. Your contribution grows, your invested capital grows, and you're giving compounding more capital and more time to work. This is why starting matters. Not because your first investment makes you rich, because your first investment starts the clock. This right here is where new investors get it wrong when starting out. Beginners obsess over returns. They ask, what's the best stock? What gets the highest return? What ETF will make me the most money? But there is another number that can matter even more, your savings rate. If you make $40,000 and invest $50 a month, and someone else makes $80,000 and invests $500 a month, their financial trajectory may look very different. Your ability to invest is directly connected to your cash flow. So wealth building isn't just an investing problem. It's an income problem, a spending problem, a debt problem, a behavior problem, and an investing problem. You have to work on the whole system. Maybe you can't increase your investments today, that's okay. Work on increasing your income, reduce unnecessary expenses, eliminate high-interest debt, build your emergency savings, create breathing room, then redirect some of that breathing room toward investments. That's how investing becomes sustainable. However, what if you have credit card debt? This is a huge one. Let's say you have a credit card balance charging a very high interest rate, and you're thinking, should I invest or pay this off? There isn't one universal answer for every person. But high-interest consumer debt deserves serious attention because the interest you're paying can be extremely expensive. Imagine you're paying 25% interest on a revolving credit card balance. You're looking at that debt every month. Meanwhile, the stock market might return more or less over any given year. There is no guaranteed stock market return that will offset your credit card interest. So don't get caught up in the idea that you need to invest every available dollar while ignoring expensive debt. Sometimes the most powerful wealth-building move you can make is creating financial stability first, paying down high-interest debt, building an emergency reserve, then investing consistently. This isn't about delaying wealth forever. It's about building a foundation that allows your investing strategy to survive. Let's make this extremely concrete. Imagine someone starts investing $100 per month. They don't have a huge salary. They aren't wealthy. They aren't a finance expert. They simply decide, I'm going to invest $100 every month. That's $1,200 per year. After 5 years, they've contributed $6,000. After 10 years, $12,000. After 20 years, $24,000. After 30 years, $36,000. Those are only contributions. If the money is invested and earns returns over time, the account could be worth considerably more. Again, the actual return is not guaranteed. Markets don't move in straight lines. But this example teaches us something important. Small contributions become meaningful when repeated over long periods. That's the entire philosophy. Stop asking, how can I get rich quickly? Start asking, how can I become financially stronger every year? That question is much more useful. Eventually, if you invest long enough, the market will fall. It's not an if, it's a when. You will probably experience periods where your account is down. Maybe 10%, maybe 20%, maybe more. And when that happens, your brain is going to scream, sell. Because suddenly that number you've been watching is red. Your $10,000 account becomes $8,000. And emotionally, it feels like you've lost $2,000. But here's where your investing plan matters. If you're investing for decades, a temporary decline is different from permanently losing your investment. Broad markets have historically experienced major crashes and eventually recovered over various historical periods. But recovery isn't guaranteed on a specific timeline, and past performance does not guarantee future results. That's why your investment horizon matters. If you're going to need the money next month, you shouldn't be investing it in volatile assets. If you're investing for retirement decades away, you may have more ability to tolerate short-term volatility. The biggest mistake beginners make is creating a plan when they're calm and abandoning it when they're scared. Your plan needs to account for fear, because fear is going to show up. Here's a simple rule. Your investment account is not entertainment. You don't need to check it every hour. You don't need to refresh the app. You don't need to celebrate every green day. You don't need to panic over every red day if you're investing for decades. Why are you emotionally reacting to 5-minute price movements? Your behavior should match your timeline. If your timeline is 20 years, build a 20-year mindset. You don't plant a tree and dig it up every 3 days to see whether the roots are growing. You give it time. Your investments deserve the same patience. Now let's dive into why chasing the next biggest stock can destroy your investment strategy. You will eventually see somebody online claiming they made 500%. You'll see screenshots. You'll see people talking about the stock that changed their life. And you'll wonder, why am I sitting here investing in boring index funds? Here's the problem. You are seeing the winner. You're not seeing everyone who bought the wrong stock. You're not seeing the people who bought at the top. You're not seeing the people who panic sold. You're not seeing the people who took on too much risk. You're seeing a highlight reel. This is why your financial plan can't depend on being lucky. If your plan requires you to correctly predict the next market superstar, you don't have a plan. You have a bet, and that's not what we're trying to build. We're building a system that can function even when you don't know what's going to happen next. If you made it this far, let's go into the simple beginner investing system. So now let's put everything together. Here's the framework. Step 1, know your monthly cash flow. Know what comes in. Know what goes out. Know what you're actually working with. Step 2, build some emergency savings. You need protection against unexpected expenses. Step 3, attack high interest debt, especially expensive revolving debt. Step 4, take advantage of employer retirement benefits when appropriate, particularly available matching contributions according to your plan's rules. Step 5, choose an appropriate investment account. That could be a workplace retirement account, an IRA, Roth IRA, or taxable brokerage account depending on your circumstances and goals. Step 6, choose diversified investments appropriate for your goals. For many beginners, broad market index funds or diversified ETFs can provide a straightforward starting point. Step 7, automate your contributions. This is huge. Don't rely on motivation. Set up automatic transfers if your financial situation allows it. Step 8, increase your contributions when your income increases. Don't let every raise disappear into lifestyle inflation. Step 9, stay diversified. Don't put your entire financial future into one stock. Step 10, stay patient. This is the part most people don't want to hear. Building
But
wealth
say you
takes
only have time.
$25. Let's say you're watching this and you're thinking, okay, but I'm seriously starting from nothing. Here's what I'd want you to do. Take your next paycheck. Look at your actual numbers, not what you wish you spent, what you actually spent. Write down your income, write down your fixed expenses, write down your debt minimums, write down your subscriptions, write down your food spending, write down your transportation, write down everything. Then identify one small amount you can consistently redirect. Maybe it's $10, maybe it's $25, maybe it's $50, maybe it's $100. The amount matters, but consistency matters too. Then establish your emergency savings process. If you have high interest debt, create a debt payoff plan. Then start learning about investing. Not 400 hours. Start with the basics. Understand stocks, bonds, index funds, ETFs, 401k, IRA, Roth, IRA, brokerage accounts, diversification, expense ratios, risk, compounding, taxes. That's enough to get started. You don't need a PhD in finance. You need financial literacy. There's a difference. You don't need to know everything, you need to start. Let me bring everything we just talked about down to one simple truth. You do not need to become a financial guru to build wealth. You don't need to predict the next big stock. You don't need to spend every night staring at charts. You don't need thousands of dollars sitting in your bank account. And you don't need to understand every single thing about the stock market before you begin. You need a system, because the biggest mistake beginners make isn't choosing the wrong investment. It's never starting. They wait until they have more money. They wait until they understand everything. They wait until they're out of debt. They wait until life becomes easier. And meanwhile, years keep passing. That's the part I don't want you to miss. Time is one of the most valuable assets you have. Your first investment might only be $25. It might be $50, it might be $100. And no, that first contribution probably isn't going to make you rich. That's not the point. The point is that you are teaching yourself. I am someone who invests, and then you do it again, and again, and again. You increase the contribution when your income increases. You stop allowing every raise to become lifestyle inflation. You build your emergency savings. You deal with expensive debt. You take advantage of retirement benefits available to you. You learn the difference between a stock, an ETF, an index fund, a 401k, an IRA, and a Roth IRA. You choose investments that actually make sense for your goals. And then you stop trying to outsmart everyone. You stay diversified, you stay disciplined, you stay invested according to your plan, and you let time become part of your strategy. Because here's what I want you to understand. You aren't investing because you know exactly what the market is going to do tomorrow. You're investing because you don't know. Nobody does. You're building a strategy that doesn't wreck